Hello, my name is Richard Black. I'm head of the College of Social Sciences here at the University of Birmingham. It's a great pleasure to welcome all of you to this 21st annual Maxwell Fry lecture in honour of Professor Maxwell Fry. As I'm sure that many of you are aware, but just for those of you who may not know, Max got his PhD in economics at the LSE in 1970, and after 4 years at our speaker today's institution, City University of London, he joined the Department of Economics at the University of Hawaii, spent 6 years there before moving to University of California, Irvine. And then shortly after that accepted an endowed chair as Professor of International Finance here at the University of Birmingham in our business school. Max passed away prematurely in 2000, and we remember him each year at this time with this lecture. Now, like some others in the business school at that time and since, Max was a very prominent figure in the world of international finance. And his work was particularly widely acclaimed in central banking circles. His contribution was in the fields of international and development or global finance. And so this annual lecture is given each year by an internationally leading academic or policymaker in a topic that reflects these Max's interests. Max was really well liked by everybody. And he took a particular interest in helping early career researchers to develop. And that too is something that we've retained here at Birmingham. Some of you may have seen the announcement recently that we've been selected by the British Academy to host the first of their early career researcher hubs that covers across the social sciences and the humanities. I never met Maxwell myself, but I know that some people on the call today worked with him and miss him very much. So with no more ado, I'm going to introduce Professor Jane Binner. Jane is our Chair of Finance, and she is going to formally welcome our speaker this year, who's Professor Alec Chrystal from Bayes Business School, newly renamed Bayes Business School at City University of London. So over to you, Jane.
Thank you very much, Richard. It's my pleasure to welcome Professor Alec Chrystal here today to present our annual Maxwell Fry Global Finance Lecture. Just by way of introduction, Alec's achieved his Bachelor in Economics at the University of Exeter, followed by his PhD at the University of Essex. His first academic post was as a lecturer in economics at the University of Manchester, before becoming an advisor to HM Treasury, working in international finance, and then followed up with a lectureship in economics at Exeter University. Alec joined the City University Business School as a professor in 1988, and then took up a chair of economics at the University of Sheffield. During 1997 to 2001, he was working as a senior advisor in the monetary analysis wing of the Bank of England, and worked in the team writing the inflation report for a period of 2 years. Then Alec returned to Bayes, which was formerly known as the CAS Business School, in September 2001 to become the head of Emerged Finance Faculty, a post he held in 2009. As many of you know, his research interests are in monetary economics, international finance, and political economy. He's famous for his books. He's authored and co-authored several books, including latest several editions of a well-known Principle of Economics book, and followed up by the Controversies in Macroeconomics with Simon Price and Political Economics with James Alt. Just to let you know that Alec is happy to take all the questions at the end of the lecture. We're happy to allow you to use the chat facility in the meantime. So please, if you wish to raise any points, we'll gather the chat and make these into discussion at the end of the event. So without further ado, I'd like to hand you over to Alec for tonight's lecture entitled The Yuan and the Dollar Crisis. Thank you, Alec.
Thanks, Jane, and thanks, Richard, for the kind introductions. I hope I can live up to at least a quarter of what you said about me, but that remains to be seen. I'm going to share my screen so you don't have to keep looking at me. You can look at a picture of Bayes instead. This is the Bayes Business School. Why it's called Bayes? I guess it's because Bayes is buried about 100 yards away down the road in the Bunhill Fields cemetery. I'm going to just click into, there we go. Okay. I want to start by sending my best wishes to Max's wife and family. Celia, unfortunately, is not, I think, watching live because she's abroad at the moment. But I hope we can connect at some future date, maybe at a future Maxwell Fry lecture. Max, I met probably on the conference circuit or probably at the money study group. But then when I went into the Bank of England, he was actually in the next door office to me. So he was a Hubler Norman Fellow in the Bank of England at the time. And obviously being in the next door office, we talked a lot and discussed a lot of the issues of the day. Obviously, we all became very, very sad when he got ill and later died. But he was an amazing guy, very lively. You certainly knew when he was in his office because you could hear him on the phone or discussing something heatedly with visitors or knocking on my door and asking questions, making suggestions, etc. You might want to know what the connection is between this lecture and Max. Well, I actually have an old copy, an ex-library copy of his very impressive book called Money, Interest and Banking in Economic Development. And because it's an ex-library copy, it's a bit like the sort of library copies you used to find of Lady Chatterley's Lover in the library. It falls open at a particular place, okay? And in Max's case, it's not the naughty bits in the book, it's the bits that the students most liked and most used. And in this particular case, in this book, the students clearly put a lot of effort into reading his chapters on financial institutions, instruments, and markets. And Max's whole career essentially was devoted to trying to figure out the implications of financial developments in the world economy for economic development. And he did many studies of many different countries. Tonight, I'm talking about sort of the reverse of that, which is the implications of some economic developments in the world economy for the financial system. Okay, so that's where I'm going. And it certainly fits into the category of global finance. I'm not an expert on developing countries like Max was, but I have worked for quite a lot of my career on the role of international currencies in the world economy. Okay, so the central question is, we know that the dollar has been the dominant international currency, certainly since the majority of the time since the Second World War. But in the past 20 years or so, it's obvious, and I'll show you the chart shortly, that China has grown very rapidly to become the largest exporter in the world. And this raises the somewhat obvious question of whether the Chinese currency, the Yuan, also called the renminbi, which has the symbol CNY, so I'll use all three of those things, so don't get confused. As far as I'm concerned, they're all the same thing, though there are some maybe subtle distinctions. The question is whether that or anything else for that matter will displace the dominance of the US dollar, which I'll show you in terms of data a little bit later. I didn't know what the answer was going to be until I went back and looked at the data, which I'm going to share with you shortly. But the main message is that there's certainly no obvious major signs of the dollar being shifted from its dominant role yet. And while anything is possible, and although I'm called Chrystal, I've tried to avoid being a forecaster and making predictions which may turn out to be wrong. But a more likely scenario in the next several decades is for possibly a tripartite world currency system, in which the Chinese currency has a substantial role in China's environment, the euro probably still has a special role. As we shall see, the euro does have is the clear sort of second place international currency. And the dollar will continue to be a lead currency in probably big chunks of the world economy, particularly the Americas, but also, as we'll see, probably in the foreign exchange markets, where it's pretty clear that the dollar is the money of the foreign exchange markets in an obvious sense that virtually all currencies have a market with the dollar. They don't necessarily have cross markets between each other. And the dollar provides the intermediary currency in foreign exchange markets. So that role, I think, will persist. I should say there is a paper, and when I have any references in my slides, the references are in the paper. If you want to get hold of the paper, you can either email me, or I think it will be on the website, probably the Money Macro Finance website, soon after the lecture. What I'm going to do is I'm first going to look at the changing patterns of world trade, and then discuss why this might be significant for the international role of world currencies. I'm then going to go back a little bit in time and look at the debates about the so-called international liquidity problem, which is what international monetary economics was all about when I was a student, related to a famous book by Robert Triffin. And the title Gold and the Dollar Crisis is essentially where I got my title from. So I've just put in Yuan and the Dollar Crisis as my title, and that's the reference. I hope most of you will have got that if you knew about Triffin's book. Triffin's statement of what the problem was led to a solution, which in my view is always was ill-designed and somewhat irrelevant. But it created an asset called the SDR, or a special drawing right, which is still around today, but you know, I don't think is going anywhere anytime soon. It's been around 50 years already, and I used to play a game with my students of saying, you know, tell me what the SDR is, and most of them had never heard of it, even the ones who'd worked in banking and foreign exchange. Okay, meanwhile, the private sector has evolved in its own way. I mean, the official sector was where the Triffin problem was focused in terms of official foreign exchange reserves and other forms of reserve. The private sector of the world economy has sort of evolved its own solutions. And of course, the dominant use of the dollar is one of those solutions. What I have called in the past the international medium of exchange. Alexander Svoboda called that the vehicle currency function. So that these are related literatures, but nowadays, I think through the work, particularly of Geeta Gopinath at the IMF and her collaborators, this is generally known as the dominant currency. Okay, so all of these things, as far as I'm concerned, are the same. There are subtle differences in the literature. The dominant currency angle, for example, is also about, not about just the global role of the currency. It's also about the impact on pass-through of exchange rate changes and open economy issues like that. So there's a bit more in the new literature than there was in the early one, but they're all connected. I'm going to show evidence which may surprise some of you, but it certainly surprised me when I looked, collected it all together and looked at it about not only is the US dollar dominant, but it actually has grown in dominance, and to some extent so has the role of the euro in trade, in securities markets, and in international banking. And then I'm going to look at the key role that the US dollar clearly does perform as a medium of exchange in the foreign exchange markets. And my guess is that this is the role that's least likely to be displaced by emerging currencies such as the yuan, even if China's rapid growth continues for another decade or two. And I should warn that obviously extrapolating from recent trends is always dangerous. As I'll point out in the case of the Japanese yen, which at one point in the 1980s was predicted to become the dominant economy and be the dominant currency, and that didn't happen. So what looks like a well-established trend doesn't always necessarily mean that it's going to carry on. I'm then going to raise something which I don't know a lot about, but I know might become an important issue, which is the use of central bank digital currency. This doesn't exist yet, at least not in the form that people are talking about. China is ahead of probably the rest of the world in developing a central bank digital currency. Clearly, it's not currently fully implemented, but the question obviously is this one thing that may be a game changer in terms of giving a boost to the role of the Chinese currency in international markets? I'm going to conclude it may be, but my guess at the moment is that the bigger impact of central bank digital currencies, if they happen, is likely to be in domestic payment systems and domestic banking systems. And it's much harder to guess what the implication of that might be in for international currency use. But I'll come back to that, and no doubt some of you will have views about that. So here's the, if you like, the killer chart that underpins the issue that I'm trying to raise. This is the percentage share of world exports between 1957 and 2018. Clearly, if you can see my pointer, the US dollar was the biggest exporter in the 50s and 60s. Germany grew in the 50s and 60s, and threat obviously has become more or less equal in terms of size of exports. These are percentage shares, so obviously if some go up, others have to go down. The yellow line here is Japan, and you can see why people in the 1980s were talking about Japan's growth leading to it becoming the dominant player in international trade. And we're also talking about the yen becoming a much bigger currency in the world economy. That didn't really happen. The role of the yen has to some extent petered out. It's possible, but I think probably slightly unlikely that the same thing might happen with China, but that remains to be seen. The other currencies in here, obviously the French franc and the British pound. The UK, obviously the relative role of sterling. Sterling was important at the end of the Second World War, and even into the 1950s a bit, but with the unwinding of the sterling area and the relative weakness of the British economy, certainly the global role of sterling has tended to diminish as the relative importance of Britain has in world trade. Okay, so what we know is for China that it's come from virtually nowhere in the last 2 or 3 decades, that it was 2% of world trade in 1990, and it's now 15%, peaking here in 2015. The latest data point here is 2018. We don't, there is not a full set of data even for 2019, at least there wasn't a couple of weeks ago when I looked for it. So obviously we don't know whether that growth in China's relative share has continued to fall or stabilize, but you know, that's an issue for further discussion. Okay, so that's the issue. Obviously, in other words, the structure of world trade has changed dramatically, and the question then is, does this have implications for the role of currencies in world trade? In case you think I'm inventing a false, what we call Aunt Sally in England, in other words, a target which is really not a serious issue. I've got a quote here, and I don't like using quotes in lectures, but this quote is just to support the fact that I'm not completely mad in inventing this as a story about what might happen. But this is from Barry Eichengreen's recent book on global currencies. And he in the quote, he says that, well, he actually has data, historical data showing that Britain was the dominant currency certainly in international foreign exchange reserves, indeed right until after the Second World War. And he points out that, you know, there is a view that there will be one dominant currency, and this is in terms of British hegemony in the 19th century. Then we switched to American hegemony in the 20th century. And then the same story of political, economic, and monetary dominance are now told in terms of Chinese hegemony. I used to say hegemony, but I'm told that hegemony is the right way to pronounce this, but I apologize if you don't agree with that. Okay, so there's the issue. So Barry Eichengreen, as far as I'm concerned, is probably the leading commentator on sort of economic history of the world monetary system, and he regards this as a kind of well-established existing view that currency domination tends to switch from, there's a sort of winner-takes-all potential outcome. At least that's what he says other people think. What he himself clearly now thinks is that the old view was wrong, and that there is a new view set out in the book that currencies can coexist as big players in the world economy. And as evidence for this, it's clear that even when sterling was the dominant currency in the 19th and early 20th centuries, the French franc and the Deutschmark, and later the growing role of the dollar had significant roles. And in the current context, it's clear that although the US dollar is dominant in ways that we'll see, the euro has a significant international role, some of which was played by the Deutschmark before it. Hence, according to this view, there's no inevitability about the Chinese currency replacing the US dollar. Therefore, one possible outcome is that these two currencies coexist, or indeed three currencies coexist, and play dominant currency roles in different parts of the world and possibly in different markets. Another indeed is a possibility that the Chinese currency does not evolve into a significant international currency, but rather suffers the fate of the yen, which was once touted as a potentially significant international money. As I said, I'm reluctant to forecast. I don't know what the outcome is going to be. And as we'll see later, I'll come back to the point, there's plenty of uncertainties around all of these things, not just about China's relationship with the rest of the world, which obviously is under tension, some tension at the present point in time. But obviously, in terms of, there are political risks in America and in Europe as well. So there's no certainties in this respect. But there is pretty hard evidence of the firmly established position of the dollar and the euro. Okay, first though, I want to go back to the Triffin problem, because this is sort of where international monetary economics came in, and also led to a particular solution, the invention of what was going to become the principal reserve asset of the international monetary system that didn't work. Okay, and the problem, according to Triffin, was that in the Bretton Woods system, the US dollar was pegged in value to gold at $35 an ounce, but US gold reserves were more or less fixed in size. And so a growing world economy would require growing balances of the US dollar in official reserves to help stabilize the fixed exchange rate system. But as the growing dollar balances got bigger and bigger, in other words, the US liabilities to the rest of the world got bigger, and the gold backing as a proportion got smaller, then the safety and the belief in that gold backing would come into question. And this would cause a crisis for the world economy as external holders dumped dollars and switched into safer assets such as gold and possibly other currencies. This was regarded as, the potential international liquidity problem. And in order to avoid this, there were big debates in the 1960s, and the answer, which was produced in a meeting of the IMF in 1969, was to invent a new, allegedly international reserve asset, the IMF special drawing right. The conception was that these would be issued to IMF members and expanded over time until they essentially reduced dependence on the US dollar. Okay, and the SDR was invented, it's still out there, and I argued some time ago, and again, this is one of the few predictions I have made that did appear to be more or less correct, is I argued in my 1978 Princeton essay that the design of the SDR was flawed and it would never replace FX reserves and could indeed speed up the creation of more FX reserves. One obvious limitation of the SDR is that it can only be used for transactions between IMF member governments. It cannot be used for intervention in foreign exchange markets, which was the whole point of foreign exchange reserves under the Bretton Woods system. A second is that the SDR is not money, it's credit. If you want to know the difference, if I offer you to give you £1,000, and then I offer to lend you £1,000 at a market interest rate, which would you think is better? And the answer is obviously the credit is not as good as getting the money. Okay, credit is different from money. And the fact that SDR offers credit, not money, is important because it explains why the major countries of the world lost interest in SDR issues for nearly 30 years between 1981 and 2009. They could borrow in the markets on the best terms anyway, so they had no benefit from the credit offered via SDR use. The poorer countries in the world, however, could not borrow as cheaply and so would benefit from greater credit at low interest rates. But IMF voting was weighted towards the richer countries, and only at crisis times could they be persuaded to be seen to be helping the less prosperous countries with an apparent handout in the form of SDR allocation, which of course is essentially is a free good as far as the richer countries were concerned. They didn't actually have to hand over any of their revenue or tax money. Even though, as it turns out, the bulk of the SDR issues go to the richer countries anyway. But nonetheless, if you think about when big SDR issues have been agreed, it's actually in the aftermath of the global financial crisis and recently in August this year as a result of the COVID crisis. Okay, so that's one of the problems. Just to show you the scale of what actually happened in terms of international reserves, the top blue line here is foreign exchange reserves. That's obviously the made up of all the currencies in the world that are held in reserves. The SDR is along the bottom here. As you can see, what didn't happen is the SDR was expanded over time, and it certainly didn't replace the most of, obviously, as we'll see, the bulk of these foreign exchange reserves are in US dollars, and so the creation of the SDR did actually nothing to replace the dollar in foreign exchange reserves. In other words, you could argue that actually the SDR came too late because obviously, by the time the SDR was really fully operational, currencies were moving to a floating exchange rate regime, so they weren't that bothered about reserves anyway. But my argument was always that actually there was a flaw in the design. To give you a scale of where we are now, we had a reasonably big issue in 2009, which is this one down here. And we've just had another big one. I've cheated here a bit because the last data point here was actually 2020, but I've added the scale of the issue in August 2021 to the 2020 data, just to show you that we've had the biggest issue of SDRs in history, but it's still pretty trivial compared to the stock of foreign exchange reserves as they are and as they've evolved in the post-war period. Gold here, I've taken the stock of physical gold and valued it at market prices. That's because official gold reserves some of them are still valued at $35 an ounce. So you don't get, it makes more sense to me to value the gold stock at market prices. The reality is the gold stock of official reserves in physical terms is more or less the same now as it was in the 1970s, but the variation here is due to the variation in the price of gold. But again, this is still relatively small compared to the enormous explosion of foreign exchange reserves in the last 20 years or so. Okay, and of course, people are happy to hold dollars, even though they're not convertible into gold at $35 an ounce. So in a sense, the SDR was what I've called previously as a solution in search of a problem, People are very happy to hold dollars. They don't care whether it's convertible into gold at $35 an ounce, because obviously dollars are convertible into beachfront properties in Malibu or apartment buildings in New York. They have good purchasing power in one of the world's largest economies. So that convertibility into gold is no more important for the international role of a currency than it has become for a domestic fiat money, which at one point in time was convertible into gold, but hasn't been for many years now. Okay, so here is the composition of the foreign exchange reserves in the world economy, and obviously the dollar is the dominant. This is the US dollar at the top. The second biggest is the euro, around 20%. Obviously, the euro took over from the Deutschmark when the euro was created in 1999. It replaced also the ECU, which was sort of unbundled, which had been created within the European monetary system. The yen has a role, but a declining one. The British pound also has a bit of a role, but a declining one. Now, this is the first chart where the Chinese currency appears. It appears right down here from 2016 onwards, but it's very small. It's about 2.5% at the end here of international reserves, but it's in the same bracket here as the Swiss franc is below it, but the Australian dollar and the Canadian dollar are roughly the same order of magnitude. So although the Chinese currency has appeared as an international reserve asset, it's still very small. And of course, you could say it's early days, and it's actually grown a lot in those early days. But relative to the established currencies, it's not. You can't regard it as a big player. So let me just say a quick word about why the SDR allocations didn't do much for the world economy. And the reason is that the SDRs, the way you use SDRs, you can't intervene with them. So the way you use SDRs is by using them to get essentially to borrow a real currency. Okay, and so for example, if a loan comes from, say, the UK in the form of sterling, that immediately increases the stock of foreign exchange reserves. So if a central bank wants to get a tradable currency, then obviously it's going to go to another central bank. If it goes to the UK and the UK says, okay, you can have some sterling and we'll take your SDRs, then that increases the stock of foreign exchange reserves. Indeed, the UK could then say, okay, we'll take those SDRs and convert them into dollars. And that, in effect, increases foreign exchange reserves again, particularly if it swaps them with the Federal Reserve System. Therefore, essentially, that's enabled a foreign exchange swap between the British authorities and the American authorities, which has the effect of moving the stock of SDRs around, but actually increasing the stock of foreign exchange reserves. So this is a sort of new form of the old phrase that loans create deposits. The SDR, in that sense, does not provide a substitute which would enable people to reduce their stock of dollars. Actually, it might well increase their need for liquid currencies and increase the facility with which they could access them. So as far as I'm concerned, after 50 years of existence, the SDR remains pretty irrelevant to the international monetary system, but clearly it has a minor role in easing emerging market liquidity constraints, and usually at crisis times, because crisis times are the only time you can persuade the major countries to accept them, accept new allocations. Okay, I want to go relatively quickly through the role of international currencies, then turning to the private market. And clearly, the ideas of the vehicle currency hypothesis, or the demand for international medium exchange, and the dominant currency hypothesis are important here. And Svoboda, who thought up the vehicle currency hypothesis, was trying to explain why there was a growing dollar banking market in Europe in the late 1950s and early 1960s, the so-called euro dollar market, which of course was not about the euro, but it was about the dollar, and it was in Europe, which is why it was called the euro dollar market. What was happening, he suggested, was that dollars were being used as a settlement medium in trade between companies and countries, even when this did not involve any direct trade with the United States. Okay, so hence they would need working balances of US dollars and perhaps trade credit in US dollars. Evidence for this international medium exchange role of the dollar or any other currency was lacking until the appearance of a famous study by Sven Grassman of Swedish foreign trade. And there was also a famous study by Cass, Williamson and Wood of UK foreign trade published in 1980. And there have been many subsequent studies, and there's a literature on that is reviewed in Philip Hartman's book, which, as I said, all the references here are in the paper. There's been a big worldwide recent study by staff at the IMF and the European Central Bank, which kind of brings the picture up to date. Now I'm going to show you a chart from that study, and the full reference is here to one of the versions, though I got this chart from the European Central Bank's publication on the international role of the euro. This is based, certainly the right-hand panel is based upon a sample of 101 countries for which trade data were available. Obviously 101 is a big sample, but there are nearer 200 countries in the world. So to what extent that sample has biases, I'm not sure. And certainly the results were somewhat a surprise to me. The point of the story, though, is that the share of exports to the rest of the world, in other words, not to the Eurozone and not to the United States, has grown since 1999. It's kind of stabilized, but it's we're looking at something close to 60% of the world trade doesn't go to the United States or the Eurozone. The Eurozone is a bigger export. The exports to the Euro area are bigger, but they've fallen somewhat relatively. And obviously the exports to the US are around about 10% of world trade. Okay, so that's the trade structure, broadly speaking. But the currency use is completely different. The euro has between 40 and 50% of exports are invoiced in euro. The share of exports in US dollars is also around 40%, somewhat over that at times. And the share of other currencies, this surprises me, and I don't know whether this is a kind of bias, it's a share of other currencies in export invoicing has fallen from around 20% to about 13% in this period. Okay, so that, in other words, the position of the euro and the dollar as invoicing currencies in world trade has solidified and not been diminished, at least not yet. The other point here is that the dotted green line here is what you get for the use of the dollar in trade if you take out the fact that the dollar is clearly the dominant currency in commodities trade. That's primary commodities, particularly oil and other energy. So the dollar has a special role as the currency in that market, and obviously that's a big part of currency turnover. And so the point of the story is in goods trade, in world trade, the special role, the vehicle currency or medium of exchange role of the euro and the dollar is significant. One explanation for this and why there's been a, if you like, increasing concentration on these so-called vehicle currencies is that supply chains in the world economy make it increasingly convenient for businesses to structure the trade of everything in the supply chain in the same currency. Obviously, it makes for more pricing certainty. So the globalization of trade and supply chains encourages the use of a common currency throughout the supply chain. I don't know if that's true, but it's an argument I've seen in the literature. Looking for some data on the recent UK data, we have official data from HMRC, that's Her Majesty's Revenue and Customs, on non-EU imports by currency invoicing and non-UK exports. The data here show clearly that the US dollar is the dominant currency and has grown in that role for the invoicing of UK imports. The role of sterling has somewhat declined over time, though obviously it's still significant at around 20%. Other currencies, the euro is used here for about 5% of our trade for our imports, even though this is not trade with the European Union, and therefore it's non-EU trade. So the euro is used as a sort of vehicle currency for some UK trade, and the Canadian dollar is the other one which makes an entry here, and the blue line, the light blue line, is all other currencies. Okay, so that's all other currencies combined. So there's no other big player in that story. This is for the this is UK exports, and obviously the sterling was the dominant currency, but that has been declining fairly significantly over the last 10 years or so, and the role of the dollar even there has declined. Sorry, the role of the dollar has increased fairly dramatically to be the dominant currency in our exports as well as our imports. The Chinese currency does make an entry here, and that's it's showing up somewhat strangely in our exports, where I would have thought it's more likely to appear in our imports, but that's the way it is. And obviously the green line here is all others in terms of UK export invoicing. Now to turn to debt markets. This is denomination of international bonds and other tradable securities. There's some ambiguity in definitions here, but I think the way to think about this is these are essentially euro bonds. The dollar denomination of the current, in terms of that trade, is clear and also increasing. The euro has a role. It sort of went up for a bit in the early 2000s. It's declined, but it seems to have leveled off. And the yen had some role in offshore bond markets, but again, that has declined. Other currencies, those are all the other currencies in the world combined. They've actually had a slightly lesser role in those markets in recent times. So that's debt markets. This is deposit and loan markets. Okay, this is the obviously the US dollar in terms of, can't quite see what's going on there, but let me see if I can get that. Yeah, okay, this is the international loan markets. So this is international banking, what we used to call the euro dollar banking. The dollar has a stable high sort of 50 to 60% role in that. The euro is more like 10 to 15%. The yen has a low role now probably only 3 or 4%. Other currencies combined make up 20 to 30%. But again, there's no single big currency in there that would enable it to show up on the chart. Okay, so there's a lot of other currencies have involved in cross-border banking. This is loans. This is deposits. Again, the big story is the dollar is the dominant player, over 50% of international banking deposits. International banking in this sense is offshore deposits by offshore depositors. Okay, so these are banks outside the dollar zone, and they're also depositors outside the dollar zone. Okay, so that's what we mean by international banking. So again, the international role of the dollar is pretty well established. The euro is the second biggest in line, and then the yen comes in there. Okay, I'm going to speed up a bit because I'm kind of running out of time. I want to show you the dominant role of the US dollar as the money of the foreign exchange markets. and that's important. I'll go straight to the data, because this tells a very strong story. This is the percentage share of the over-the-counter. That's the sort of bank-to-bank foreign exchange markets. This is for all instruments, so it's spots and forwards and other derivative instruments in terms of currency terms. The dollar. This is the sources, the BIS triennial surveys. The dollar is, broadly speaking, about 90% of the turnover. And what 90% means here, these numbers actually add up to 200, and that's because every foreign exchange deal has two currencies involved. So 90% involving the dollar means that 90% of trades have the dollar on one side of the deal. Okay, and that means that if it was 100%, that would mean that there are no other bilateral currency markets that the dollar is involved in every single foreign exchange trade. But the fact that it's 90% is incredibly high anyway. And the explanation for this is that foreign exchange dealers themselves use the dollar as a settlement medium. If they want to go from one currency to another, they go through the dollar rather than trying to look for bilateral trades. So in this context, the euro has a strong kind of second place. Then we've got the Japanese yen, which still has a significant role, followed by the British pound. Again, the Chinese currency does appear, but only in recent data, and it's got something like 2.5% of the turnover in foreign exchange markets. So it's certainly growing, but it's still a relatively small player in this market. There are some other data a bit more timely for the UK, for the London market, but this essentially tells us exactly the same story. This is from the Bank of England's half-yearly survey. Again, 90% turnover of dollar, nearly 40% turnover of euro. And given this is in London, you'd expect the euro to be a bit higher in this market, as is the pound, because this is in the London market. And obviously the GBP is the grey line and the Japanese yen is the yellow line. Again, it tells the same story. The Chinese currency does come in here, but again, it's about 2% of the turnover, and it's only just visible in terms of, along with a number of other relatively smaller currencies in terms of foreign exchange turnover. Okay, so the question then is, given this dominant position, will the US dollar be deposed? And if so, what might shift it? Well, obviously, Chinese growth alone in terms of trade hasn't done it so far. Clearly, we need probably more liberalization of Chinese financial and capital markets, obviously more credibility and openness of the Chinese authorities themselves, and greater liberalization. The problem is, of course, that relationships between what we used to call the West and China have actually deteriorated recently, and so this may push the attractiveness of the Chinese currency in the opposite direction. And what we don't know is what the future holds politically in terms of the relationship between China and the rest of the world. Obviously, any further problems will probably slow the development of the Chinese currency as an international currency. Of course, there are political risks in the US and in the Eurozone. Obviously, if you look at Panicos Dimitriades' book on the Eurozone, there are plenty of political risks around that too. However, in terms of actual use and the credibility in markets, the Fed and the ECB have so far at least managed to maintain the attractiveness of their currencies. One of the innovations that the Fed introduced in the recent crisis is swap lines and a repo facility for central banks to essentially be able to get liquidity from their dollar reserves more easily. And obviously the final thing I want to mention is the possibility that one thing that could move things in favor of the Chinese currency is the central bank digital currency. And that could be a game changer. But I'm going to skip through this quite quickly because we're running out of time and I want time for questions. But the point of the story is that China is ahead of the rest of the world, probably in developing a central bank digital currency. And obviously, to be a genuine innovation, that must involve wider access for businesses and households to direct claims on central bank deposits. This, of course, will have some impact for domestic banks and domestic payment systems, but the implications for the international system are less clear. Possibly, though, if China is ahead of the game and this makes access and transactions cost in the Chinese currency lower, then it could stimulate the international use of the currency. But of course, it's quite likely that if that does happen, then other central banks will react. We know they're all watching developments and they're thinking about developing their own central bank digital currencies. But again, this is something for the future, which could be significant and may shift the balance of power of international currencies. But then again, if it happens, it may not have that implication. That remains to be seen. Okay, so to conclude, the status quo of the dominant dollar in the international monetary system seems pretty firmly established. The growth of China has dramatically altered the structure of world trade, but so far has done surprisingly little to change currency use in the international economy. What happens in the future will depend on politics as well as economics, but it's likely that the international role of the Yuan will grow, at least in China's sphere of greatest influence, and thus we may be heading for a three-currency world. To return to a quote from an earlier book by Barry Eichengreen, the fundamental fallacy behind the notion that the dollar is engaged in a death race with its rivals is the belief that there is room for only one international currency. History suggests otherwise. Aside from the very peculiar second half of the 20th century, there's always been more than one international currency. And there's no reason that in a few years from now, countries on China's borders could not use the renminbi as their international transactions, while countries in Europe around the Eurozone use the euro, and countries doing business with the United States or in the Americas, I guess, use the dollar. There may have been only one country with sufficiently deep financial markets in the second half of the 20th century, but not because this is exclusively an intrinsic feature of the global financial system. I tend to agree with that, obviously, as I'm putting it in here, and I am going to conclude on that point, and I look forward to taking some of your questions. So I'm now going to reappear in physical form. Okay, over to you, Jane.
Yes, thank you. We've still got 7 or 8 minutes left for questions. We could open with Paul. Paul, would you like to get back with your digital currency question?
Thanks, Jane. So my question was really picking up on your last point, Alec, about the emergence of digital currencies and whether that's going to eventually take a dominant position relative to the US dollar or the Chinese currency. And particularly as the network for the use of digital currencies grows and perhaps more online transactions take place.
Well, it could. I mean, that's why I've read. If you read the literature, I mean, there are lots of people who are big fans of this and think it's going to be earth-shattering. The problem is we don't really know. I mean, central banks are looking into it. They're all sort of planning that they think they might have to do it. Some of the, I don't know whether you've seen the literature that came out of the sort of joint BIS group recently, which is about as opaque as I could possibly imagine in terms of explaining where they're up to and exactly what form these things might take. Clearly, you know, certainly if China is ahead of the rest and they make it work, that could have an impact, because obviously with the widespread use of technology, if something is easier to do transactions on, we know that China has banned the trade in cryptocurrencies. It won't so it won't allow the development of Bitcoin, etc., or the use of Bitcoin in Chinese trade. Other countries haven't decided to do that, but I think most people now agree that the cryptocurrencies, the private cryptocurrencies, are not a real threat. They're not going to grow into international media of exchange. But we don't know about a state-backed digital currency. What we do know is that the Fed and all the major central banks are looking at it, and they're sort of thinking about it. But if I was there, I'd be much more worried about the impact on the retail payment system and the domestic banking system, and how you allow this to happen without destroying the commercial banks in domestic markets. How this spills over into international markets is an interesting question, but I really don't. I'm sort of guessing at this as much as anybody else, and I don't think that's where the central banks are at the moment. They're not really thinking about that. They're more thinking about domestic payment systems and how they would fit in without killing off the commercial banks and other payments providers. But again, it's clearly going to be a big issue, because I presume it's going to happen in some form. Maybe several years, but with all these things, the full implications are very hard to anticipate. I don't know if you have any views about how this might work out for the international economy, but clearly if it made transacting in renminbi or yuan much cheaper, then it could shift the balance. But obviously it would have to have a pretty dramatic effect to shift the current position, particularly the role of the dollar in foreign exchange markets, which it seems to be so firmly and stably established that it would take something to shift that.
Thank you. And David Cobham, we have a question on network effects, please, David. So David is asking, if you introduced more on network effects, see the work of Meisner and Ohm's decline of sterling, etc., this might suggest some more abrupt shift might be possible.
That's certainly possible. Obviously, in a sense, the dominant role of the dollar as the money of the foreign exchange markets is a network effect. Once everybody uses it as the intermediary, then it has a more liquid market and it has lower spreads and all of that. The question is how much of a change does it take to shift that? And in that context, would you jump immediately from one dominant currency to another? It's clearly possible, but I would, I think it would take a big shock, for that to happen. And those things are possible. Anything's possible, obviously. It's also possible that political conflict would halt the whole thing, and that there could be physical conflict between nations, and obviously that would have implications too. So speculation. I agree the network effects are precisely what gives the dollar its dominant role in foreign exchange markets. Not quite so much, I guess, in terms of the role in other markets, but certainly in terms of foreign exchange markets. But that is so well established now. I'd be surprised that it would take something pretty dramatic to shift that, I think.
And a question from Turale Kenk. Do you envisage a greater role for SDR if it's designed along the lines of the old European currency, the EQ?
Very good question. I mean, the SDR has been around for 50 years, and I certainly argued that at the very least it needs to be tradable. It needs to be an IMF money, but of course that would change the role of the IMF from being simply a lending institution between governments to being a world central bank, and that would essentially require the issue of a tradable world currency. Of course, that could have a role. That in a way is the way we perhaps should have gone, and that may help. If you think about China's problem in terms of international reserves, the one thing China can't hold in its own international reserves is its own currency. So that having an international currency, which is out there in world markets, would indeed be one way to go. But it wouldn't be the SDR then; it would be something quite different. And clearly, in designing the SDR, the world authorities resisted that move. They wanted the SDR to be not so as radical as a new world currency, which could in principle be and in reality would be a threat, but it would have to be the liability of a world central bank, which is not really what the IMF is. But indeed, we could go down that road, but whether you can get people to agree to it, I very much doubt.
So on that note, I should say that it's come up to time. Alex, happy to take any further questions later. I know that some of you may have to go. It's 6:30 now, so we are due to finish. Alex said he's happy to stay on a bit longer if some of you would like to stay and chat a bit more, because obviously this year, this lecture's been a long time in the making, and Alex very happy to deal with questions. He's an international expert in this field. It remains for me to thank you for coming tonight, and Alec, for such a stimulating and insightful lecture on such a popular topic. So our audience tonight is one of the largest ever at this memorial lecture, and it's testimony to the wonderful reputation you have as a world-leading expert in international finance. So I wish you every success with the publication of your paper. And there's a lot of valuable data here too, so thank you very much for allowing us to record the lecture. We've recorded this so we could all watch it later to help our research. And thanks to Richard Black for opening up the lecture, and to Max Everett, our events manager, for the highly efficient organisation and enthusiasm. So I wish you all a lovely rest of the evening, and thank you very much for coming. I look forward to welcoming you again next year to next year's lecture. So thank you and good night.